Hello everyone and welcome to today's webinar on position sizing and risk allocation strategies. I'm Ali Mortazavi, Head of Education here at Toronto, and I'm thrilled to have all of you here with me today. Whether you're new to trading or have years of experience, effective position sizing is one of those key skills that can make or break your success in the market. So I commend you for taking this time to invest in your knowledge with me. And please confirm to me if you can see the screen very well and you have the voice in a pretty good in quality. So I would make sure if everything is fine from your side, that would be a comfort to continue this webinar together. Thank you so much. Okay, thanks a lot. Thank you. I'm getting a lot of good. I see. Let me check my screen sharing right now with you, and then let's make sure everything is fine. Okay, can you see my screen right now? Thank you so much for your comments. Okay, that's great. So let's continue. Actually, today's session is all about giving you the tools you need to protect your capital and optimize your gains by calculating the optimal position size for each trade. We will cover different methods to allocate risk, and I will walk you through how to create a position size calculator or how to use the very nice predefined feature in TradingView with Arante. By the end of our time together, you will understand not only how to size your positions properly, but also how to use visual tools to make the process easy and intuitive. Before we jump on our agenda today, it was mentioned that this webinar is brought to you by Arante, which is an online broker. We are committed to providing top-tier services, especially educational services at the top, to build lasting and trusting relationship with all of our clients and partners. So please take this into consideration that the all materials providing here, all the information, it's just for educational purposes. So please don't take them as any financial advice or any, I don't know, trading signals or something like that, or the example we'll discuss in the live charts. That's only for you to learn and may practice it later. So also be aware that the CFDs products are so risky. So it's really important to make your due diligence first before you invest your money. Okay, saying that, now let's start by understanding why position sizing and risk allocation matters. Before getting into the agenda, let me tell you this explanation that as traders, we know that markets can be unpredictable. Sometimes they move in our favor and other times they move against us. The key factor that differentiates consistent traders from those who struggle is not just a strategy. I've been saying that for a long time, but risk management is the key here. So this means ensuring that no single loss wipes out your account. Position sizing isn't just about placing a trade, it's about ensuring that when the trade goes wrong, you leave to trade another day. So in this webinar, we will explore a systematic approach to determine how much you should put at risk in a trade based on your account size and risk tolerance. First, you will learn how to structure your trade. Yeah, as you see here. So that even a string of losses won't devastate your account. And this is foundational, and I'm excited to guide you through the process today. Okay. First, calculate the correct position size for each trade. You will learn how to determine exactly how much capital to commit to each trade, ensuring you never risk more than you can afford to lose. And we will discuss how setting a consistent risk percentage per trade helps in maintaining stability across different market conditions and building long-term profitability. So then we will, I will try to illustrate how you can use custom labels on TradingView charts that will allow you to visualize your position size instantly and with greater confidence. And these labels will help you visualize the correct position size directly, and it will make the day easier for you. And then reducing the time spent calculating and improving to the speed of your decision making. And also you will learn how to identify correlations somehow among different trading instruments if we have enough time and allocate risk accordingly. Of course, we are going to cover that as well. So that would help you to avoid doubling exposure inadvertently. Yeah, so this is a thing that we are going to discuss here. But if you have any question, please just write it down to me through the chat box you have, and I would be more than happy to answer you if I know the answer. So let's start with the basics. What exactly is position sizing? Simply put, the position size is something wrong with my slide, I guess. Let me just, yeah, excuse me. Let me just fix it in a second. Cool. Okay, I was saying, simply put, position sizing is determining how much to invest in each trade. The main factors involved are your account size, your risk tolerance, and the characteristics of the particular trade you are considering, because we are going to extract the stop loss from that. So to calculate the optimal position size, we use a simple formula. I'm sure if you are following our webinars, you know that we had covered it in a very greater details before. However, I'm going to provide you a recap here. First, okay, position size has a formula, and to calculate the optimal position size, we use this simple formula here. Equals the product of your account size and risk percentage divided by the stop loss distance. It's easy. There are many different other ways, of course. However, I found it very helpful because it's really simple. So you can just calculate this across a variety of different financial assets. So in other words, position size, as you see here, can be calculated using this formula. However, let me break that down for you. First, we have risk percentage represents how much of your account you're willing to lose in a single trade. So for most traders, this range between 1% to 3%. And by staying within this range, you ensure that even if you hit a streak of losing trades, your account remains intact. And next, the stop loss distance is the, let's say, difference between your entry point and where you plan to exit if the market moves against you. And this is critical because it helps define the risk in terms of pips, points, or dollars. So let's work through an example together to see how this plays out in practice. Okay, imagine you have a 10K trading account and decide that you're willing to risk 2% of your account per trade. This means the maximum risk for any trade is $200. Yes? So if the stop loss on your trade is set to 50 pips, the question is how many lots should you trade? We plug the numbers into our formula to answer this important question. And if we do so, that gives us a risk amount per trade, which can be used to determine the correct number of lots. If you're trading Forex, we can adjust our lot size to make sure, let's say, the total risk stays at or below the $200. As you see here, when we plug in all the numbers in the formula, we get the answer of 40K or 40,000 units of base currency. Depends on the pair we are trading. For example, if it's a Euro USD, it means 40K Euro. Or if it's, for example, GBP USD is 40K sterling pounds. And in the other term, you can just divide this number by 100K, so you will get the lot size, and that in this case is 0.4 lots. This is, you see, it's a very, very easy, but what does it mean for us? Okay. It means if you open a trade of 0.4 lots, okay, and set your stop loss 50 pips away from your entry, and let's say in any case, if you get it wrong, okay, your analysis doesn't work, and the market hits your stop loss, it means at the worst case scenario, which means hitting your stop loss, you will not lose more than $200. So this is a thing that with the account of 10K, you can make sure you're not going to blow out, you're not going to get a stop out for the market, and that's a just case. So in that case, you will be able to refine your strategy, maybe to improve it, maybe to consider some mistakes that you had for this trade, and then you can come up with better strategy, or you can come up with a better way of better timing, trade timing, or let's say better, or you can calm yourself down and get out of this stress, and then you can get back to your trading desk again. So in that case, it means you have just lost $200 out of your 10K balance. So it's totally fine, and you might be able to make it up in the rest of your trading journey. But if you go nonsense with any amount greedy, if you become greedy in trading this on a setup, and then with a 50 pips stop loss descents, you might wipe out half of your account, and that would be a disaster for any trader, you know. And then the problem is that recovering your account after a loss is much harder, you know, than losing money. So in that case, you will find yourself in a huge trouble, and you might get, let's say, disappointed. And this happens. I've let's say talked to many traders before. Most of those who are, let's say, novice to trading, and this is their first month, their first year, or something like that in trading Forex, they're so excited about the market fluctuation. They usually go very aggressively greedy on the market, and they think, okay, now I think it's gonna go up, and I'm not gonna miss this opportunity. So I'm gonna, for example, go into this full margin, and that in that case, just once out of plenty of opportunities, if you get it wrong, it means you are putting your account in a huge nonsense risk. Why it's nonsense? Because recovering this risk is taking much more effort. Uh, and that's the case. Many of them usually get disappointed, and that happened to me many times when I started my journey as a forex trader. And it's really important formula. So write it down and keep using it for your trades. And how you want to use it doesn't matter. We'll get into that. But let me just add one more thing. Once you grasp the idea of how much to risk per trade, you take it further to risk allocation. The key is diversification. Let me discuss the diversification is in a little detail. Yeah, not putting all your eggs in one basket. This is a diversification. So our risk allocation isn't only about how much to risk per trade, but also how you distribute that risk across different opportunities. For instance, if you are trading multiple currency pairs, it's important to avoid over allocating risk to correlated pairs. If you have trades open in both, for example, Euro USD and GBP USD, a sudden movement in the USD could lead both trades to fail simultaneously. Thereby, doubling your risk will cover methods to manage such correlation risks, ensuring your exposure stays within your acceptable limits. So to help you maybe further, we have had some webinars on allocation diversification. That's about the correlation analysis between and the tools, very useful tools that you can find in around the TradingView. Okay, let me just switch to my TradingView a window to share it with you, and then we will be able to continue. Okay, sure. Okay, please let me know if you can see this. Okay, one of the tools that you can use and with TradingView is this. You can just go here is the correlation coefficients is let's say in oscillator indicator. You can find the correlation between, for example, here I have the gold, and you can find a symbol you want to measure the coefficients coming from a Pearson ratio if you are familiar with correlation. So in that case, I'm going to choose, let's say, if I can find the US dollar index, that will be, they usually call it XY. See, yeah, the currency index is coming from around here, but for now, it doesn't matter. Just let's, okay, really see. The correlation coefficient with the USD, between USD and gold is changing a lot. And based on the Pearson formula, which is oscillating between 1 and -1, it means when it's getting to -1, it means they have a very strong negative correlation. It means when one goes up, the other goes down. So this is a negative correlation. And you can see here right now it's almost -0.84. So this is a considerable negative correlation between them. And sometimes, however, it gets positive, and this is a very strange one, but doesn't matter in that course. we walk through all of the details you might need about the correlation analysis and about the economic factors and all the systematic risk and the non-systematic risk that can impact the different asset classes. So yeah, so I'm not going to discuss it here further details. Please accept it from me just to this point right now, and then but feel free to maybe explore all the other webinars we have at aroundtit.com to take a look at maybe those correlation analysis sessions. Okay, so here one thing, so we use this CC oscillator to measure the correlation, and we are not going to expose our account to a very correlated pairs unintentionally. You know, it doesn't matter if you have a calculated risk to go there, that's fine, but we really don't want to get surprised by the market because we already have a loss on our plate. Okay, so I'm gonna close this and look at here what we have. This is the gold on it, let's say 30-minute time frame. I'm just gonna walk you through the, and this is a very nice breakout, by the way. See how it would just make it nice and clean. Right now here we have something like a breakout maybe here, and also a break trying to break above this very important resistance level here. It can pave the way for the higher let's say targets. Yeah. And okay, so how we can use I wanted first, let me explain this. I wanted to explain you how to use the let's say Pine editor, Pine script, how to write it using ChatGPT or something like that. But I came across this trade order, let's say order panel or order window here in TradingView, and found it much more useful and much more simpler than the other tools that you may want to somehow, I don't know, encounter, incorporate in your TradingView is the Pine script, and writing all of the coding may be correct, and maybe being cautious about the reliability if they are correct all the time. So that's why I came to realize that we can just focus more on this very, very useful trading panel, which is, I believe, in my opinion, one of the greatest and the bold advantages of TradingView ecosystem here. So let's break down each section. We are going to take a closer look at the trading panel as shown shown here. In this panel, particularly configure important parameters when placing a trade, such as lot size, risk percentage, stop loss, and take profit. So let's break down, and this, of course, it's very, very helpful for position sizing. Break it down each section. First, we have the order type here, okay? You can go for sell or buy, and you can choose between the instant orders, which is a market execution, or the limits, a stop or a stop limit orders. Okay, that's fine. And which means here you can choose how you want to enter the trade. The market order will execute immediately at the current price, while limits or stop orders allow for entry at predefined levels. Let me make sure if my screen record is not paused. Okay, so let me know if it's fine. Cool. Okay, it seems fine to me. Please confirm if you also see my screen. or please inform me as well if you experience any issue with your screen, or you can see my trading view. Thank you. Okay, so what the first thing we have here is here is the price. Let me just put it a bit down. Okay, here we have the price, we have the ticks, and the lot size here is automatically calculated based on the percentage of your balance that you're willing to risk. For example, here, if you just turn turn the stop loss to here, you will be able to set a predefined level of risk. It can be in terms of USD, and please note the cash quantity equivalent in the order is approximate. However, it doesn't include the commission, or depends on the actual order execution on the extreme, but it can give you a very very clean picture of how much we're going to risk. And then you have the percentage balance, which is the the one I really like, this percentage quantity equivalent in the order. It's still approximate, but doesn't matter, because when you can set it, for example, at any predefined lot size. For example, let's say I'm going to take one lot on gold, okay? But to give you a better understanding, let me say we are going to trade only 1 ounce of gold, 0.01, okay? So I can set the percentage of my balance. I'm going to risk 2%. And then when I want to choose my stop loss, I have the different options. I can set it in terms of ticks. I can set a predefined price. I can set USD. Let me change it to buy because the market looks more bullish than bearish. Yeah. And I can set the exact, let's say, amount of money as my stop loss, or I can set a percentage as well here. For example, let's set the 2%. The 2% of my balance, okay? So how much is my balance? You see my lot changed exactly to get me the only 2% risk of my balance. And how much I'm going to risk? My account balance right now is at 6,813.89 cents. So in that case, the 2% is almost roughly $136. So this means when I choose the 2% balance and I choose the 2% balance for my stop loss, I can get a predefined a level here. Let's assume that we had this level in mind to enter the market, 2997.17, okay, for a buy. Sorry, for our entry, okay, let's say 597.17, and here we are going to set our stop loss at this last market bottom here. It's 2580.39. okay, so with this size of position, I'm going to risk 6.4% of my account. So it's too much for me here, but I'm going to set it to only 2%. Let's see what happened. If I change it, you see my predefined level is changed. So I don't want that, okay? I want to stick to the chart because I have this stop loss level here based on market analysis, and this is a market button. It's not going to change. If I change my stop loss here, it's not be let's say proper stop loss. It's not going to be protective stop loss. So I'm not going to change it from here. I want to change it from here. But here I'm not going to change more than 2% of my balance. In that case, I can just check the percentage risk. So here you see the percentage risk is not going to change my stop loss as a price here. It's going to change my risk percentage and my account size. So if I change the 6.4, which is the current calculated percentage risk that I'm going to take in this trade, if I change it to 2, you see with the same price level as my stop loss, I will get 0.08, get 8 ounces of gold I'm able to take. In that case, I will not risk more than 2% of my account, which is almost roughly 135. You see, it's an approximate number, but it's really, really helpful. So how you can calculate your position size here is very simple. Using the risk percentage, set your predefined stop loss level here, and that's it. And let's see what will happen if I want to get a full control of my risk management rules beforehand in trading market. I can just take the take profit, turn it on, and then you see I'm also able to set a predefined TP level. Let's choose this 200%, which is the equal length to this correction here. Okay, so it's going to be as this amount. So you can see based on the current market, it's going to be something like the 2%. Let's say win or 2% profit I can generate based on my balance, and the risk to reward ratio should be 1. And I can find all of this information down here in this box. It's the order info, leverage, and 500 to 1, and the lot size going to be it's not the lot size. Okay, let me explain something here. Lot size here, it means how the amount that consists one lot is a contract size, okay? And the tick value for now, based on the trade we are taking, is just the 8 cents. Why? Because the trade value is the required margin I need based on the leverage I'm choosing. So the reward and the risk here, you can see it's both equal. So reward to risk ratio for me is only is a 1. Okay, and this is the best way to calculate your risk using the TradingView trade panel. Okay, so after all, we'll also explore adding custom labels. It's nothing actually, but it's very helpful. These labels provide a visual check of your risk and position size, ensuring that before you place a trade, you know exactly what's at stake. No visual feedback and really makes the whole process intuitive and helps ensure you stick to your risk rules. In that case, it's really easy. And in TradingView, you can have this. You can add text easily here. You can set this as your stop loss, and you can set this at your TP. As your entry. So this is my regular Fibonacci map. And if you have watched our, let's say, webinars on risk management, you have seen how we develop something like a partial take profit levels and using Fibonacci. And this is a very, very easy way. And this is very helpful. And as we are at this breakout, so we can consider this as a first TP, this is a second TP, and then we have the third TP. And you can of course, you can choose the appearance, the colors, and of course the place aligned with the line here. It's very nice. It's very easy. The label, you can put them at the center, for example, like this, or you can put them at the right, like this. And for the text, you can set them at the left, for example, like this, and you can set them at the middle. So it would be very more visualized. Not it's let's say more telling. Yeah. Okay, so to summarize, today we covered the importance of calculating the right position size and manage your trading risk effectively, and we looked at how to decide how much to risk per trade and how to calculate the position size and how to automate this calculation using TradingView tools. The most successful traders are those who avoid losses. Losses are inevitable. We all know if you have traded Forex, you know. So instead, they are the ones who manage losses so well that they are mere bumps in the road rather than setbacks. And this is the quote. Effective position sizing is your toolkit for ensuring exactly that. So let's now open up the floor for questions. Feel free to ask anything, whether it's about calculating position sizes, using Python script, or anything else from today's session. So let's get back to our screen again. Okay. Okay, thank you all for joining today's webinar on position sizing and risk allocation strategies. I hope you found it valuable and that you have a stronger understanding of how to manage your risk effectively. Remember, mastering risk is what sets successful traders apart. Keep practicing, stay disciplined, and you will see the results over time. If you would like to review any of the materials covered today, or maybe you can find it on our website for sure, and you can also explore the our previous topics on risk management. We walked through a very great details how part by part we explained all the let's say ingredients of successful trading plan and risk management. So you will also get the recording of this through your email day after this webinar. Okay, so until next time, trade smart and take care.